All right, we are back with another Friday financial wrap up with Mr. Michael Zuber. How are you, Michael?
I'm doing well, man. I just got to say, it's so awesome that this is so important to you to get done. You actually are doing this a day early from the back of an Uber. Man, you are awesome. I appreciate you.
I am in the back of an Uber. We are recording this on Thursday, May the 2nd. This is for May the 3rd, 2024. We're doing it early because why, Michael? Tell
Well, it's because you're going on vacation. That's why.
them. Yeah, that's right. There's also a big Fed number tomorrow. So
Yeah.
we obviously, that'll be dropping news tomorrow. Let's get right into it. The Fed, CPI, PPI, all the different inflation. We're not through the woods. What
Yeah.
happened with the Fed this week, and what are your thoughts? Where's your head at on all this?
Yeah. So let me just say, kind of off the cuff, I'm disappointed in the Fed this week. Um, and again, they kind of did everything I expected them to do, except one thing. Um, and so let's get into it. We had Fed Day this week, no rate increase, no rate cut, as expected. The press announcement, kind of a nothing burger. They lowered, uh, they are increasing liquidity by reducing the bond rollout. They actually reduced it more than the market expected. So liquidity is coming back to the system. It's interesting because the one thing that I wanted them to do, I initially thought they didn't talk about. So this is breaking news. I've been really digging in the last 48 hours or 24 hours on this. And I wanted the Fed to come out and say, you know what? Basically, we'll hike rates if we have to. Right? I'm the man in charge. I got this. If I have to go higher, we will. I've never thought they should go higher, but I want them to have the stick so the market reacts. And the line in the press conference was, it is unlikely that our next move will be higher. Well, that's not a no, right? It's unlikely. But I just recovered or discovered that Jerome Powell removed a line from last month's speech, where the last line in the speech said, "Hey, we are at the terminal rate," basically. He removed that. So he's letting the market know suddenly that if they got to go higher, they will. I wish they were more forceful. Why do I want that? Because if you're paying attention, Jerome Powell in front of the microphone says, "I'm a dove," and the market rips. Market was up 500 points or something almost immediately. Bonds were down, zero point 0.1. It was basically, to me, high. And why it annoys me is the rich got richer. If you owned assets, you got richer. I wanted Jerome Powell to come out and say, you know what, we may have to go higher, and that would have shocked the market and readjusted prices and all of those things. But he didn't do it. So yeah, the Fed wasn't as hawkish as I had hoped for.
Very interesting. It's interesting too that I saw a lot of comments just on Facebook. I saw loan officers talking about, people excited about cuts coming and things of that nature. That's kind of the interpretation on the street of LOs and such. What was your? I mean, is that of course?
Ow.
I mean, is that even realistic? I mean, do you think we're even going to see a cut before the election? Do you think it happens in September, or what are your thoughts now?
No. Yeah, I think we made a call together about 3 weeks ago on this weekly show that my call for the first rate cut is November. It will be the Fed meeting right after the election, right? The election, I think, is on a Tuesday. The Fed meets on a Wednesday, right? Gives the announcement. So it's right after. I think that it might be a week off, but it's somewhere in there. I think the first rate cut's November, not September, not June, not May, right? It's later this year. And I would tell you, I'll tell you this. If you told me, Michael, what do you think is more likely? Zero rate cuts or two rate cuts? I would take zero. I think zero is more likely than two. Um, yeah.
Yeah,
I yeah.
that that yeah. It seems like too. With talk about a little bit about inflation. I think like the last three readings, the last five readings, it feels like the trend broke. Explain that a little bit. Let's back up on that. Talk about that a bit.
Yeah, inflation is not only proven to be sticky, it's actually reversed course in many metrics, right? So it's not like a flat line. It's actually an upward slope. If you go back and look at Q1, January, February, March, if you go back and annualize the last 3 or 6 months, as the Fed told us to do months ago, because they thought they were winning, the numbers don't look good. In fact, we continually are getting metrics. Like Thursday morning, we got another indication that wages are going up. There's a survey that was expecting a 4% wage bump, and it came in at 4.7. So it just feels like 80% of the inflation numbers we get are hot and getting hotter. That is why I wanted the Fed to come out and just make the threat, because they may be backed into a corner. The other thing that's really interesting that happened yesterday is Jerome Powell came out really, really hard against the idea of stagflation. Stagflation is a worst case scenario for the economy. And Jerome Powell is basically like, the economy's strong, still growing. Inflation is sticky, but not high. I don't see stagflation, but and he probably has to say that. I mean, because it's such a horrible outcome. But dude, there's so many metrics. You know, Stagflation has gone from an unlikely to a certainly a possibility. And if anybody wants to go look at what stagflation is, go back and look at the 70s. It was not a good decade.
Very interesting. Very interesting. And so, of course, 30-year mortgage rates softened up a little bit,
Hmm.
uh, just a tick, right? Looked like we were headed to eight. We were at 7.5. Felt like we were headed to eight, or at least
Hmm.
high sevens. And then, it had a little softening.
Yeah.
How do you think this all plays out with rates and just kind of even even before even before this the Fed announcement, people thought rates were going to head back down to, high sixes. We were
Hmm.
just floating right above 7.25. We went to 7.5 pretty quick. What the hell's going on with the 30-year mortgage, Michael? Make it make sense for the average person listening or watching.
Yeah. What I would tell someone right now is I think we're range bound. I suspect the 10-year is range bound. I think the 30-year mortgage is range bound. Now, this is owner occupants. This is not investors, because you have to add on top of that for investors. But it would not shock me if 30-year mortgage ranges between 7.25 and 7.75 for most, if not all, this year. Um, unless, a nasty recession kicks off or something. But I think we're range bound, which means, you know, it's going to be the the real estate market slows down at 7.5, less transactions, longer days on market. Which, if you're in the business and you're focused on transactions, it's going to hurt. But if you're on my channel and you're an investor, you're a buyer, it's coming your way. I mean, just for example, this morning I read an article from Redfin in the state of Florida. In the state of Florida, they have 5,600 listings where in the description says motivated seller. Now, that's very much a Florida problem at the moment. But if the market slows down enough, trust me, folks, some people have to sell. Not everybody. Some people want to sell and they'll just take it off the market. But some people have to sell. And if their property's not perfect, doesn't smell good, it's not updated, it's not going FHA, there's plenty of opportunities coming if you do the work.
Spot on, spot on. One thing I wanted to ask you too, because just following the daily financial news, um, you said just now also you said the word recession, and so I want to go back to this week's daily news. You talked about Starbucks
Mm-hmm.
and what a kind of a disappointing announcements earnings they had, and tying it back to like China and 18 months ago I believe when China also had a similar. Maybe just kind of elaborate on
Yeah.
that for the weekly viewer here.
Yeah. So I think as somebody who looks at economic data every day and also earnings from the big public companies, sometimes you have to cross pollinate both. And I think there's a lot of folks that think the economic data we're getting is lies, fabrications. So what I do when I question the data that I'm being fed is I look at earnings calls because as an accountant who had to go through certifications and quarterlies, those numbers, revenue can't be fake, right? Earnings can be manipulated a little. But when I look at Starbucks and I see that they're down 7% same store sales in the US and 11% in China. Now, granted, this could be very much Starbucks specific, right? They could have their own challenges and do, but it's just another sign that the consumer could be breaking. We also had data from McDonald's. Consumer is breaking. We've had Dollar Tree and Dollar General, whatever it is, go out of business because it just you can't do it anymore. So I think there's increasing signs that the consumer is stretched. I mean, if you want to look at the high end consumer, look at Lululemon, look at some of these other clothing brands. There's a lot of folks pulling back, and the consumer ties we talk about they drive the economy. If the consumers pull back, bam, we're in a recession immediately. So it could be happening right now.
Very interesting. So, any other insights for this week or things that you think are important? I know we always talk about do the work. I think with a weird market, a broken housing market, there's tremendous opportunity for those that are out there actively, doubling down on marketing, doubling down on work ethic, doubling down on, getting out there, networking, talking to people, finding deals. Just kind of what are your takeaway or just maybe some final thoughts
Yeah.
as we kind of lean into the spring and summer?
Yeah. At the end of the day, do the work always work, but this is the most important time. We're only doing great deals. We're going to have to follow up. We're going to have to write lots of offers. You are looking for the person that has to sell, not wants to sell. Watch your buy box, look at days on market, look for price cuts, look for signs of a slowdown, and then strike. Cost of capital should matter to you as an investor. You're going to write up a deal that makes sense at 8%. Fine. Then if rates ever go to 6, you refi if you want to. But this is the most important time to do the work. Get in a community of people doing the work so you can support each other. It's hard. It's really hard, but it's also really worth it.
I love it. Thank you, Michael. Folks, if you like this, continue to follow. Please subscribe, like, comment, and share. Michael, thank you for all the work that you do. Have a great weekend, brother. Take
Take
care.
care, man.
Thank you.
Bye.